John Gatewood, and this is the Gatewood Wealth Solutions weekly market commentary broadcast. And with me today is Aaron Tuttle, our Chief Investment Officer. Welcome, Aaron.
John, I'm glad to be here and not watching TV last night still.
How about that? I mean, I'm not sure that was a debate as much as it was a verbal wrestling match.
It was certainly an argument, maybe?
It was a spectacle for sure.
Yes.
So one of the interesting things I did was I went online to see what are the debate etiquette rules. Do you want to know what they are?
Everything that didn't happen last
Right.
night?
Do not speak out of turn or interrupt, right? Do not insult, offend, disrespect debater or moderator. So I think every etiquette rule was definitely broken last night.
Yes.
But we're going to talk about the impact that may or may not have had on the market. But I think that one of the interesting terms that you came up with this week is instead of the campaign trail, we're in the cat pain trail.
Yeah, the cat pain trail.
All this catting talking to each other. Well, let's talk about our timeline. I know, in fact, we were talking last week that we will revise our timeline going forward because now we're getting into the fourth quarter and we're understanding a little bit better about kind of what to expect and things that we're going to be monitoring now that we're at this stage of the coronavirus.
Right.
So that's something that our listeners can expect that over the next few weeks we'll try to get some type of grasp over so we can give them some way to create an expectation of tracking for the next 12 months. What do you think of that?
Well, typical John Gatewood fashion that you want something done that's probably going to take a couple of months to be done.
Let's go faster. I've never heard that one.
Yeah, so I'll push back on saying we're in that time period in the economy where it's kind of a kaleidoscope. We've seen the trends that happened before. The kaleidoscope is now moving. While it's in movement, we don't know what the pattern's going to be yet. So we really need to let these trends establish, see what's working before we can put up a timeline on how likely the new pattern, the new economy is going to be structured. That being said, we continue to move along this timeline where we're in that stage of industrial activity rebounding, and we'll see those numbers coming out this week. Things still look positive. It is a little bit of a lagging indicator. We still think that despite all the election headwinds, that 2021 will be an expansion year as we move out. It's just we're still waiting to see what trend line is going to really take hold so that we can start to say, well, then this would be the timeline on that trend line.
Well, let's talk about the Fed and stimulus because I know that they decided that they want to hold interest rates where they are for quite some time. The problem is that they're not really seeing the inflation trends that they're hoping for, at least yet. So how should we interpret this going forward in terms of their future actions and what they even have at their availability to do?
Well, one, the Federal Reserve is starting to see some sluggishness in the high frequency data, which that's more real time data, and we've been concerned about what would happen in the economy for some time. The Fed is beginning to see it, and as you said, their monetary policy really they have used all the tools that they have available without going to negative interest rates. So that's why the Federal Reserve is pushing for fiscal stimulus. They have played all of the ways that they can help the economy are in play at the moment. So they're really looking for that fiscal stimulus to help push us over the edge and get the economy going. Regarding inflation, we've been very cautious and need to look under the hood. I know that we've bounced some articles back and forth as we prepare each week for what we're going to cover on the things that people are buying. Definitely we're seeing inflation in those areas that are not, whether it's travel and leisure, gasoline. Those are all parts of the index that have been declining. Eventually those bottom, and each time that they decline, they become a smaller part of the basket. So we do think inflation is going to show up at some point in the indexes.
So let's talk about what's being proposed for federal stimulus by the House.
Right, I've changed the slide several times as we're preparing for these talks because there's just been so much happening.
Right.
But the House did approve the HEROES Act. There'll be Nancy Pelosi and Mnuchin, the Treasury Secretary, will be trying to hammer out what this deal looks like. Really, the big contention between Democrats and Republicans is bailing out the states or having some aid to the states, depending on where you fall on that political line. We have up here the credit ratings of the states, and there are certainly states that really do need fiscal help from the policies that they've put forward, and then you compound that with the lockdowns and the amount of revenue that the states have lost, Illinois and California being the biggest. But we don't think the Senate wants to push this forward, but we also don't think that it's really going to happen before the election. It's really the Senate needs to decide. Not only are they contentious against the state funding, but there's another matter that has popped up, and it's probably going to take more of a political center for the Senate, and that's the nomination of Supreme Court nominee Amy Coney Barrett.
So do you think that the outcome of the election could also reshape the form of whatever the stimulus is that they're going to ultimately pass?
I haven't thought about it on what the election outcome would be on how they would address that. So I don't know. I don't know how that would affect it. I would have to really think about how the Senate and the House would have a different incentive depending on the results. It may be that the House pushes something through knowing that they may have the House, the Senate, and the presidency. So that's a good question, but one I don't know that I could adequately answer at the moment.
But it probably won't really have the real impact until after the election.
Right.
But I wouldn't you assume that no matter what the results are of the election, that some stimulus will be passed in any case?
I do think that there will be some type of stimulus passed after the election, especially if we start to see some of these negative numbers with the Fed saying that the high frequency data is becoming sluggish. Now we do have complications to that with Florida reopening, which we can talk about in a little bit. But we have said continually on the market update that we either need new stimulus, which would probably only kick the can 3 months, or we need to let the economy open, which then will allow the money supply to be more organically increasing, or more lending would be happening to allow that money supply to increase.
So let's talk about the mail-in ballots. I know that's been a hot topic. It's cooled off a little bit this week because of other things going on, like the Amy Barrett potential nomination or selection to the Supreme Court.
I don't know. Yeah, it's hard to say cool off. There's just so many other competing hot topics now, right? A lot of this, whether it's the Democrats being concerned about Trump not conceding the election. This was certainly in the debate last night. And then Trump said, he would certainly concede the election if he actually lost. The only way he would lose is if it's rigged. So he's in this position of either I win or I lost because it's rigged. And then we have the mail-in ballots, which have been centered to the concerns, Republicans saying fraud, but there's now a new twist, which the moderator last night talked about, that it's not so much the fraud, and we have said, and actually got a little bit of criticism on pointing out that no, there is some fraud that happens within the voter voting, but it's usually not major enough to make any difference within any of the political races except where they're very close. It's usually a small percentage, but when we're looking at how many of the mail-in votes are actually disqualified, that were legitimate votes.
Yes.
That's a much bigger number than any of the minor components of fraud, which only matter in very close elections.
Or there could also be snafus. For example, New York just announced that they had mailed out 100,000 mail-in ballots, but they all went to the wrong person.
Right.
So what other types of snafus like that could happen as a part of this whole process? And
it seems that there are rumors high in the Democratic Party that they're actually cooling down on the idea of mail-in ballots. And remember, we've seen 40% 40% of Democrats are considering the mail-in ballot option. And if we look at some incidents where it's up to 20% are disqualified, many of them are legitimate votes. They forgot to sign, or the signature doesn't match, etc.
That could be a significant
yeah,
number, especially in a close race.
Right. We're talking about 8% of possible votes heavily weighted to the Democrats. So we may be seeing this come off the table just because of the risk of having legitimate votes disqualified.
Well, let's move on to last night's spectacle, which was a lot of fun for
I would
a little
think,
while.
yeah, I don't know about fun. Dumpster fire, maybe?
Dumpster fire. But I think some people expected the market was going to have a significant reaction depending upon this. But what really happened? Not much, right?
Yeah, most of it, I think, is priced in. We've known about the political uncertainty, and it just shows how contentious the current election is.
I mean, do you think that this moved the needle at all in terms of voter decisions and how we might look at the portfolios as we approach the election?
There really are not that many people, from what they can tell, that are undecided. Somewhere between 11% to 6%. I think anyone that came in supporting Trump liked his red meat approach, and they're going to defend him. Anybody that goes into Biden will point out, see, Trump is a bully. So I don't know that it changed the minds on a lot of people. If anything, maybe those undecided voters, there seems to be a lot of people towards that center that want to get past the lockdown. And I think Trump was strong in saying that he will not do the lockdown, and Biden talked about safety, as well as the tax code. So if they are concerned about rising taxes, maybe those 2 points sway them. They were so poorly argued. I don't know that they were actually picked up. So I don't know that much happened out of the debate for people whenever they're making a decision on who they're going to.
Well, let's talk about the coronavirus and the lockdown, because I know that on our next slide we're showing that the coronavirus cases are up, and the concern that some heard in the debate was if Biden was elected that he would shut the economy down. Now, I don't know that that is indeed the case, but what would the risk of that be should we continue to have this rise in cases as we approach the flu season and if Biden is elected?
Well, a shutdown would certainly hurt the economy significantly, and we'll get into Europe is actually not considering it, and they're having cases. But when we look at the numbers, we have seen new daily cases begin to increase over the last couple of weeks. Now, Bank of America had a very interesting slide, and that's off to the top right, where it shows the amount of new tests coming on the market. We definitely have a lot more options. We have rapid testing. A lot more people are getting tested. So that perfectly correlates with the rise in new cases in the U.S. And then when we look at the positivity rate of those cases, it continues to decline. So that explains a lot of it. Now, once again, correlation does not prove causation. So there may be other things going on here. The thing that we need to look at is the fatality rate in the U.S.
And so how are we doing?
Well, it's a lag. It has been declining, but if you notice at the very end, we start to see some flattening of the daily deaths. So it's still too early to tell to see how much of an effect the new cases are having and how many additional deaths, which is really the true litmus test of the spread of the coronavirus. So it's still a little too early to tell. But when we looked at the new CDC estimates on the fatality rate for the coronavirus, they've actually continued to decrease the numbers over time. Didn't get much press. One of the Wall Street Journal journalists sent out a tweet, and I think he's basically just taking the opposite number, but I think it's an easier way to read the numbers. So if you're under age 65, there's less than a 0.5% chance of fatality from contracting the coronavirus. That's a very low number. Now, we're not saying that the coronavirus is without risk. We've been very adamant about saying if you are in above 70, or if you have comorbidities, this is a significant risk to your health. And if we look at 70 and over, there's more than a 5% chance.
Right, that's really where the inflection point
right.
is how do we protect the people who are over 70?
Absolutely,
Because those are the ones that truly have the highest risk and true risk.
Right, absolutely. If we had 5% across the board, it doesn't matter the age group, no one's arguing about lockdowns, no one's arguing about masks, no one is being contentious. This would be catastrophic if it was across the entire population, for sure. So those that are over 70 are certainly in a high-risk area, but we begin to see better and better data, and that's where the arguments are coming. Do we lock down or the entire population and all of the negative effects that has had through indirect deaths that we've covered previously, whether it's suicide, whether it's missing cancer treatments, whether it's increased risk of heart attack because you don't want to go into the hospital. All of that goes away if there was a 5% component. So once again, the risk if you're over 70 is very, very real, but this may give us different policy options.
I think that's the number one thing is really what should the policy be? And I think that's where there's been a lot of confusion because it's been more of a general policy as opposed to one that's really specific to how do we protect this particular class of people. But there is some more reopening of the economy.
Right, so
we just saw in Florida that they've reopened.
The governor has reopened the state fully, and it so far most of the restaurants, what I've read, are at capacity. Some have called it like a New Year's Eve night. It's so busy there seems to be this demand. But the governor said that all state restrictions on businesses are removed. That there's a general right to work, meaning that that you cannot close businesses. If you're a restaurant, the counties and cities cannot restrict your capacity to below 50%. And this is also removing teeth from those cities and counties. You can no longer assess fines for not wearing a mask or not being in capacity. However, each individual business can still be more strict on the state guidelines. It's just counties and cities can no longer be more strict than the state guidelines. So I'm sure
we'll still find that some businesses are going to continue to stay in sort of a lockdown phase just because of the nature of their business and the risks that they have.
Yes, each individual business, each individual person has different risk profiles, different situations that they're dealing with, so they're going to have a different approach on how they're doing it. It's no longer going to be a one-size-fits-all, and it would probably be wise for those that are in the that are 70 and above, especially if they have other risk factors, to probably continue to quarantine and isolate themselves, doing the curbside. And the benefit can be, and I think this is the Sweden model, is that the younger, less risky generation can continue to contract the virus so that we can get closer and closer to that quote-unquote herd immunity, whatever number that is, so that we can stop it by having the people that are least risky bear the risk of catching the virus so that we get to a point where there's not enough susceptible people in the population for the virus to continue to spread.
So let's talk about second wave because we know that we are now experiencing increased cases, but there's also a phenomenon of this happening across the globe.
Right. So where the U.S., and we don't have data for each country, it does, you can explain a lot of the increase based on the numbers due to the increase in testing. We don't think that's the case in Europe, but we're not going to pretend that we have as good of data. We don't. And nonetheless, the Eurozone does not seem to want to do additional strict lockdowns. They were very strict. They flattened their curve well below the U.S. The U.S. was heavily criticized, as well as Brazil and Sweden, because they took more of those cases early on. Well, now that susceptible population is not nearly as low as it is in those countries that have kind of taken their lumps initially. So we do think it's likely that this second wave is real and not due to increased testing. But there's a lot of pushback in most of these countries where there's protests to the point of, in some places, riots as well, to push back against any additional lockdown, and then we can see the financial outcome. Many of these countries are hurting financially and do not want to have the economic fallout from locking down further.
So are there any collaborative talks between nations on policies, given kind of the phases at which different ones are with regards to the coronavirus spread?
There's certainly some collaboration. I mean, if you think about after the Imperial College report, which has since been heavily criticized and, on their method, most of the countries did go to a lockdown phase other than Sweden. So it does seem that there is a lot of overlap between countries on their policy response. That's probably going to continue. But we are also seeing different experimentation, such as Florida. If Florida opens up and there's not significant ramifications for doing so, you'll probably see other countries, other states copy that. So
yeah, I think that'll be a real telltale sign to see what happens there. So it'll be interesting to track that the next few months.
Similar to tracking Sweden, which we had talked about last week, that they may have already received most of their infections and gotten close to that tipping point where there's not enough people that are susceptible that the virus can quickly spread. And we were looking for an uptick. And if you look at the numbers, it's not the same slope, so the uptick was not as substantial in Sweden, but there was a rise. It's now continued to decline. And if we were to use our technical analysis where we chart, Sweden's technically still in a declining trend, but you do see an uptick there. If it does continue on that decline, that does suggest that they've seen the worst of it, but it's still too early to tell. And seeing that slight rise says that there was something there.
Yeah, I mean, it'd be nice if we could have a better predictor on this, but the reality is we just don't have enough experience, and it's going to just take time.
Yeah, absolutely.
But so one of the things that we noticed, we've been tracking the GDP growth, and that's really been on a slowing trend.
Right.
So is that causing us concern for our portfolios? Where do we stand on that?
Well, it's the GDP slowing is not causing us concern in our for our portfolios. We're at 14% growth rate. That's certainly not sustainable long term. The time period where the U.S. can have 14% GDP growth, we're a very mature economy. That's just not sustainable long term. We're coming out of that recession, and the further we get, the slower the growth in the GDP because all that recovery has happened. So it's not unusual to see this slowdown. We do think that the slowdown, it doesn't have to be slowing at this pace this early on in the recession. So we are a little concerned about where it's slowing down, and that's more to do with those unemployment numbers. You can see that where we've kind of stagnated. Now there was a surprise in the amount of employment due to some ADP numbers that came out this morning. We haven't had a good chance to really dig into that to see what numbers were kind of shuffled around. Is that a good reflection of reality or not?
Yeah,
so we're digging through it.
We also saw the headlines yesterday that Disney is going to let go 28,000 employees.
Right.
So where is that?
And that's Disneyland,
offset?
Disney World, with the reopening of Florida, and it seems that there is an increased demand in going to restaurants. Do we start to see some of that pullback? It's still too early to tell, but we definitely find the unemployment and kind of a lot of these businesses throwing in the towel as concerning whenever we're talking about this stage of the recovery. We should see better numbers than what we're seeing at this stage.
Well, one of the bright spots is that people's equity is growing in their homes because the home prices are going up, and it still seems to be a strong market. How long can we expect this to go?
Well, we don't see a bubble in the housing market as of yet.
I'd say that would certainly be something that would be in people's minds when they think back to 2008.
Absolutely, and we've talked about it, and I don't want to get too technical or too wonky, but when you look at the spreads to borrow to buy houses, it's pretty low. The demand to move into larger houses after the lockdown experience is certainly there. The desire to move away from urban centers because of protesting, but more specifically, that small percentage of the protesters that were rioting certainly has changed some things in the near term, and we think that is driving the housing prices. We don't think that we've expected a pullback and a slowdown in the overall market which we've been experiencing, we have not expected that in homes because of the increased demand and the ability to get very inexpensive financing for those homes. But we haven't seen prices, or we haven't seen action like this since 14 years ago. And that was on the downside of 2006, where we were in a bubble. We don't think it's reached that level yet. It certainly could over the long term if we keep interest rates as low as they are, which every indication by the Fed is that they will remain low, especially if the demand to move away from the city and have larger homes because of fear of additional lockdowns is certainly going to play.
Well, speaking of the city, the residential home real estate has been doing well, but then the commercial real estate is the opposite.
Absolutely.
And what's interesting, we had talked about how the decision that Trump made to shut down the economy actually caused a large divot in his own net worth, which is interesting that he certainly didn't make a decision that was in his net worth favor.
Well, we're assuming that, but I think it's a good assumption. Banks are writing down commercial real estate property, especially hotels, by more than 25% right now. So what Vice President Biden said, where most of the gains through this have gone to the high income earners, that's truth to that. They have, but it's mainly Google, Amazon, things that were the COVID stocks. It was not the people that are real estate moguls. They have certainly lost in this area. Now, anyone that's going to tell you what the trends are for these and what it's going to be long term, once again, it's that kaleidoscope. We have no idea how entrepreneurs are going to address and what the society looks like. It could be that because so many people are working from home, you start to lose some of that networking effect by being in offices together, and the amount of money that large companies are saving by not having big real estate footprints for office space could easily be diverted to having a quarterly get-together with all of your employees in one of these large hotels with great space to bring back some of that networking and building that social capital and that teaming. We're not saying that this is what's going to happen. We're just giving it as a counterexample of it's still too early to tell to see what are the long-term effects for these large real estate spaces, because it may be that entrepreneurs see an option to buy these cheap and meet some new problems that are going to be generated because there's a bigger work from home aspect taking place. And we still haven't seen if work from home actually is going to work for majority of the businesses. There's still issues that have to be worked out with that. I'd say 5 years from now, we're going to be like, oh, it was so easy. Do X, Y, and Z.
Right.
Why didn't we think about it? It's just so obvious. And it will be obvious looking backward, but it's not going to be obvious looking forward.
Well, we're only 3 months away from Christmas, and we've already begun hearing those Christmas ads on the radio and TV, the internet. But I'm wondering, what's going to happen to Black Friday with COVID? Are they going to have that this year? Is it going to be a virtual Black Friday?
Well, certainly, the Amazon will have some type of a component they do each year, and it's probably going to be quite a banner year for them. One thing that we want to talk about, especially for individuals that with grandkids or kids, that they want to buy their Christmas toys and Christmas gifts early, because global trade. Inventories in retail spaces, retail businesses are very low, and it does take time to fill. And we're not really seeing large shipments coming in. If you go to the San Francisco ports, you're not seeing the big containers, ships coming in every day, as every other day, a couple of days. So it may be difficult to find some of the gifts that you're trying to get. So I would recommend that you start your Christmas shopping early, so that you have time to gather those, because there is a chance that you won't be able to get some of the gifts that you're.
So how do you think that would impact retail stock prices?
Well, it could detract from them. There's whenever a big popular toy comes out for Christmas and it's so hard to get, know that is manufactured scarcity. So the ads that are there to push, let's say the Tickle Me Elmo is one of the examples that I can remember. They really push that toy knowing that there would not be enough not enough of them to go around, and that is intentional. They actually restrict the supply. And why do they do that? Because if you do a lot of purchases for toys in December, January drops off and your earnings are off. So they intentionally create a scarcity around those toys because you're going to replace. I can't get my son or daughter this very sought after toy. Maybe I'll get it in January and February, but because I can't get them that, I'm going to get them this great alternative, right? And then they start playing the ads again, especially for the children on their TV shows the following January, and you're running back out. So what they've done is made sure that they sell the amount of toys that they do in December, but then they still have some toys that are going to be sold in January. So how the retail world and the toy manufacturing and just the gift Christmas gift world, how they're going to play this. They are very intelligent, capable people, and they know how to make sales happen. So I'm sure they'll figure it out.
So the money supply, of course, is one of our big indicators that we track, and we're still on that downward trend. From what I see from the chart, it seems like the slope is lessening a little bit.
A little bit.
But isn't it still concerning for us that the trend is still negative?
Well, our indicators is whenever we're looking at this is still a negative indicator, and we have seen a big drop in money supply. We don't think we've seen the bottom of this market sell-off, which I'll talk about in the next slide. But we think we've gotten a large amount of it already showing up. And if we start to look at the week-to-week change, we are starting to see some growth back into a positive signal. We're still several weeks away from that being a potential, but we are starting to see the money supply begin to slow on its drop after a massive amount of money that has been created. And a lot of that money hasn't made it into the market. Now we talk about the growth relative to the previous growth as being the big factor, but as some of those the weeks where we had substantial growth start to drop off, then the numbers start to look positive again. So we'll be watching the number supply, the money supply closely, and may have a positive signal coming up.
We had talked about in the past about the amount of deposits with the banks and how the banks have gone out and bought a substantial amount of treasuries to push them up significantly beyond what their trend was. So there's certainly a lot of cash that's still sitting on the
A lot of Tier 1 capital and a lot of the money that's still sitting on, including the government's money. A lot of that is just still sitting in the Treasury. One has to wonder if President Trump would not use some of that cash as we get closer to the election, especially if the fiscal stimulus policy does not go through, to help kind of create a synthetic fiscal stimulus with what has already been created. So we have not spent all of the CARES Act.
That's another reason why you should not be out of the market, because if that does happen, I mean, that's of course an artificial increase in asset prices, but that's why you want to be in those assets that are going to be affected. So you were talking about not bottoming out yet or getting close to the bottom.
Right.
Let's talk more about that.
So we have, for many, I would say months now, talked about climbing the wall of worry, which was this trend line that we had been going, and we broke that trend line a couple of weeks ago. So we're no longer climbing the wall of worry, which is concerning. It's one of the we were thankful to raise cash for cash hubs, adding the portfolio insurance and making some changes, including leaving convertible bonds to go to the Barclays Ag, a little bit more defensive. We still think there's some downward movement, but we've seen probably 60% of that. We think at worst we're around 3,000, I think it's 62 for a retracement. Yes, 3,062 would be kind of a hard bottom for us technically. That is normal for a rally like this to see 30% of that increase from the bottom to come back off, kind of stabilizing, and as well as having a 200-day moving average that would be around that number. And we'll probably, if that was to happen, I think the likeliness of a fiscal stimulus also coming out is high. So
in layperson's terms,
we've probably seen most of that.
What does that mean when you? So if we hit that 3062 number,
That is a buy signal.
okay, that's what that means. Okay. So the dollar is also another area that
Yes.
we've been monitoring because it's been quite volatile, and that impacts market pricing too.
Yes.
Tell us about where we are there.
So the dollar, whenever we look back over the last 15 years, it is still relatively high versus other currencies. One of the things that we look at is what's known as a death cross and our golden cross. Death cross is whenever the 50-day drops below the 200. That happened. It's one of the reasons that we've added mid-cap, small-cap commodities, gold, because we do think the dollar is weakening and will continue to weaken. This last week, though, it's bounced off some support. It's rallied strongly. It's really hurt gold while doing that. But we think with the amount of monetary policy, especially with additional fiscal stimulus coming, or at least being proposed, and it seems that both parties want to get that through. It's just arguing about how to get it through. That we think that there's still a lot of headwind for the dollar, and it'll probably get closer to the lower range before this cycle is over. So we're bearish on the dollar and positioning the portfolio to that effect.
Then that leads us to our themes. So
Yes.
how are we emphasizing our portfolios now relative to our themes?
Well, we continue to think the big risk out there is inflation, and that's one of the reasons we have gold, commodities, and have favored assets that should do well in an inflationary environment. And either way, you're not getting paid enough in bonds to offset that, so we don't think that it makes sense to add a significant exposure to that downside whenever these risks are there and you can't be really compensated for trying to take them out of your portfolio.
Well, it certainly falls into what the Fed wants. The Fed wants inflation because that's
Yes.
really what makes their monetary policy work, and that
Yeah.
is the specific effect of their actions that they're trying to have happen.
One of the things we have here is that we favor technology, and we didn't get into this on the debate where after watching the debate, what are some of the things that we would do to the portfolio considering some of the things that we heard? And the idea that if Vice President Biden becomes President Biden, that the likeliness of going back into a lockdown is real, as well as possible tax increases. Both of those favor technology, specifically the COVID stocks that have caused our portfolios to do so well. We have been slowly moving our exposure away from them. There's still going to be an overweight in our portfolio, but that risk right now would indicate that they probably play a bigger role in our portfolios going forward until there's some clarity around who is going to be the next president out of this election.
So let's talk about the relative strength. You said that gold lost some steam
Yes.
this past week. What's holding up?
Well, technology, which is actually the last couple of weeks we talked about losing to the benchmark. We had an overweight to technology. There's the media is talking about a rotation into value. Value is supposed to outperform growth over the long term. Hasn't happened over the long term over the last 20 years. And we have been hesitant to leave technology despite seeing some of that softness showing up. One, because we want to be data dependent. And the data is telling us to keep it on there. Plus, we think that it has a lot of upside potential. And last week, it came back, and it came back in a strong way. That's why it is green on this list. You mentioned gold. It is negative. Gold miners are still positive versus the S&P 500. So are commodities. So we're in the right positions. It's been a rough couple of weeks whenever relative to the benchmark. But we've advocating holding your nose and holding the technology stock because our rules indicate that's what to do, and don't second guess. Every now and then we're right on our second guess, but when we look back at the data, it's almost always better to just go ahead and follow that process.
Well, one of the things that's been in the news that actually has not gotten a lot of press just because of all the different things going on this year, and that is that IPOs, the number of IPOs have actually exceeded all years going back to pre-2000 and when we really had that hot market with technology, the internet and so on. What's causing that, and how should we be viewing that in our portfolios? Because we don't go out and buy IPO stocks.
No,
right?
it's usually a bad idea to buy an IPO unless you're early on and you're going to get the IPO price, and you're not going to buy them in the secondary once they go and they trade. There's usually a big rush to get them. There is a lot of demand, not much supply, because the few people that do have the shares are unlikely to sell them. So you almost always lose trying to buy an IPO in the secondary. One of the reasons that they're probably issuing it is it's been a while since we've did a lot of issuing. There is concern that the market is overpriced, overheated, and long term we could have some problems. So companies are wanting to issue it and kind of sell, kind of the same way for insider trading. We're seeing a lot of management sell their stock into this. Now, that doesn't necessarily mean it's a bearish indicator. They're just taking advantage of the opportunity. Furthermore, there are a lot of platforms. Let's take the Robinhood platform. A lot of retail trade and what the industry calls dumb money. Not to say that everyone on there is ignorant on it, but they do. It's usually not portfolio managers that have extensive research teams, a lot of data, a lot of money to go. And because there's so many people that are speculating on these platforms, that may be a way to really offload those IPOs and get people to pay significant prices for the IPO. So the Robinhood phenomena that has happened through this crisis, where what was it, Hertz, where they came out and they were basically bankrupt, and people are buying their stock and driving it. That's a market that you want to be unloading your IPOs in, and that may be one of the reasons that we're seeing so many IPOs come to market.
Now, you had mentioned the Supreme Court nominee, Amy Coney Barrett. Let's assume that she is indeed installed on the Supreme Court. Will that have an impact on the market? I mean, is that something that we look at in terms of our investment committee?
It would. I think it'll have an impact on the market, depending on where we are in the election when that happens. Because one of the political uncertainties that is getting priced in is that it could be contentious. It needs to go to the courts to determine who won the election. And if you have a divided Supreme Court 4-4, that just adds to political uncertainty. So filling that in prior to the election outcome may cause the market to kind of rally some. I don't know how much of the market price is actually affected. There's just a lot that's going on. That's not the only political uncertainty. But I would expect to see a rise, not because the market views her beliefs and the way that she would rule as positive. It's just removing some of that uncertainty. We talk about how once a president is elected, doesn't matter whether their economic or their policies are going to be bad on or favorable on the economy. Just knowing removes some uncertainty, and you move up from having something known.
Well, I'd say that one of the questions that our advisors are getting from clients is this whole political uncertainty.
Yes.
And so what do you have to say to those clients who are concerned about this political uncertainty, and they're thinking, oh my God, something's going to happen to my portfolio. Am I really in the right place? And I just don't want to have a big loss or a big drop in the values of my account. What do you have to say to those people? Usually
the big drops in the market value are short-lived. Remember 2016, everyone assumed Hillary would be the president, and then once Florida went to Trump, all of a sudden the odds started to move away from her, and there was a significant sell-off overnight. It was so short-lived that if you were not trading the overnight futures, you weren't able to benefit from that. So what happens is money in motion, and things begin to sell off as people say, well, we need to set up for something else. CEOs, CFOs, the C-suite, these are smart individuals. and they're going to see how the game is going. The rules of the game are being laid out. They're going to make changes pretty quickly. They're able to operate whether it's a Democrat or a Republican at 1600 Pennsylvania, and they're going to make those changes. So other than a rearranging of how capital is allocated depending on what those rules of the game are going to be, it's usually pretty short-lived. We had talked about in a previous where really the trade policy and inflation risks were a far greater impact on portfolios whenever J.P. Morgan was modeling than whether Biden is elected or not, most of which would be the tax policy changes that would shift more of the financial burden towards companies, which means that their earnings would pull back. So you would have that initial pullback. Also, if you have increases in capital gains, we've talked about this before, yes, you get an initial drop in the value of stocks off that announcement, but now it's more costly to trade. So then you actually have less supply of stocks being traded on the market, and that actually can push the value of the stocks up because there's less supply and there's still demand there. So it's just, there isn't an easy way of saying Republican good, Republican bad, or Democrat good or Democrat bad. The economy and people that are running the economy and making the economy are very clever people. That's why they're in their position, right. And they're going to be able to operate.
They're all going to be trying to figure out, now, how do we not just survive but thrive,
right,
under
absolutely.
Whatever the rules of the game are going
absolutely.
to be. So another thing that's been on the news specific to the election night is the fact that Wall Street's been preparing for a significant surge in trading because they expect more of what happened in 2016 with the Clinton-Trump election, that a lot of that same volatility is going to happen that night. What are our expectations, and how will we be monitoring that? 'Cause in fact, you remember that on the election night, that next morning you came in really early because
yes.
there was a lot of significant early volatility, and we wanted to make sure that we were on top of that to inform our clients if something bad happened or good happened.
Or
and there was good that happened.
There was. The market did bottom overnight and then began a significant rally as those tax cuts were priced into stocks. So there was a significant rally out of that. I think Wall Street will be able to handle any additional volume. They typically do. That doesn't mean that it's perfectly efficient and they're not opportunities. We don't have access to futures markets in the way that some traders, let's say in New York, would have access. And I think that's probably important if you want to benefit from that volatility, because I think it will be short-lived. That being said, if we get to election night and we don't have any idea who that is, well, that uncertainty is going to go more than just over a night. It could go weeks. There's even some that are saying it could go months. So then there would be plenty of time for the different outcomes and different uncertainties is going up, just like we see the betting odds right now. It's not going to move in a straight line, so there would be opportunity. Ultimately, we think that our strategy of measuring relative strength and looking to see what is the market pricing in, what is doing better than the benchmarks, and we think there's a lot of smart money there that give us a nice little tell on, hey, this is what seems to be shaping up as a trend, and those trends tend to hold long enough for our strategy to benefit from them. So we'll be watching them.
Well, that's all the time that we have for today, but I do want to assure our listeners that when the election night does come, we will be here, and if there is something that needs to be reported, we will be online, just as we are now. That's the beauty of technology today, and thank goodness for a YouTube channel.
Well, absolutely. We started this during the sell-off in February, March, to be able to better communicate to our clients. We do it typically on Wednesday, but there's no reason we can't move that around like we did early on the time. So we're very grateful to be able to reach our clients. We are on Zoom, but remember, we now have the new option of watching on YouTube Live. So we continue trying to increase the availability of hearing what Gatewood Wealth Solutions thinks is the right approach and how we see things, so that clients can get our take and understand how we're addressing their needs and specifically what we're doing in the portfolios.
Well, to that end, if any of our listeners would like to contact our team and have an initial conversation or a review of their portfolios, you can reach us at our main number, which is 314-924-5100. And we are here available if somebody wants an assessment of their current portfolios and like to get a different view. Now, if they do want to learn more about us, how would they subscribe to our YouTube channel?
Well, one,
I'm not as technologically savvy as many of the other young people.
we are trying to whenever they get approved for YouTube, we are trying to put it on LinkedIn. So if you see that, go ahead and click into the YouTube video, and down below to the right, you can hit subscribe, so you'll be notified whenever new videos are uploaded. You can also go back and look at our calls. I think we've done really well throughout this crisis, and you can see that's the play-by-play and have the benefit of knowing what would happen to see how well we did. You can watch our videos in the rearview mirror, I guess. Is the way to say that. But no, please subscribe. It does help. The more subscribers that we have, the better technology that YouTube provides. So those subscriptions does help so that we can continue to communicate in a timely fashion with our clients.
So I want to thank everybody again for listening in today, and we will be here again next week. Our goal is to give you our view of what's going on in the economy and the market so that you can be better informed. Thanks again, and so long for now.